everyone, welcome. You're watching Business Today Television. I'm Sakshi, and this is a special edition where our focus is going to be on the Q4 earning. This time around, Persistent Systems is on our radar. The company has reported its numbers for Q4 of fiscal year 2024, with both the top line and the bottom line beating most of these street estimates, whereas there has been a slight miss as far as the margins are concerned. So the company has seen an increase of 14.9% in the consolidated revenues in Q4 to 2590 crores. The EBIT is up by over 3%. However, the margins were slightly lower by 8 basis points at 14.4%. The net profit, however, has seen a jump of 10.2%. So, joining us now to discuss more details on the quarterly earnings, to share more insights on the outlook going forward, is the top management of the company now. Mr. Sandeep Kalra joins in. He's the CEO of Persistent Systems. Warm welcome to you, sir, to Business Today Television. Good to have you with us. Good set of numbers coming in from the company this time around. Do tell us, on the margins front especially, why is there, a slight dip in this quarter? And you also said that perhaps going forward over the next 12 months, the growth path is something that you are going to be focusing on as far as top line is concerned, but the margins will remain flattish. What is the key reason for it, sir?
So first of all, Sakshi, thank you for having me. So from a overall perspective, if you look at it, Persistent, this is the fourth year in a row that we have outperformed the competition. At an overall industry level, if the industry for the last 4 years has grown at 1.6%, 18.6%, 10%, and 2.7%, Persistent has had a relative outperformance more than this by 12.9%, 35, 11.3%, 16.6%, 25%, and 11.8%. Now, when you look at the world economy right now and look at the conflicts that are there across the world and the Fed commentary on the interest rate, the cuts that people were expecting, they seem to be getting pushed out given the overall, macro environment in the world. Now, given that as a context, if the ambition for Persistent is to be the top quartile growth company, then obviously you can't optimize for margins and the growth at the same time. So you are essentially dealing with a hand where the market conditions are tight. You are aspiring to be among the best growth company. You're building the company in terms of capabilities for not just the next 2 to 3 years, but for several years to come. So that's where we are basically saying growth is a priority, same margins. If we can improve, we will. And at the same time, we have very clearly said in our earnings call, next 2 to 3 years, we said we will improve the margins by 200 to 300 basis points, and we stand by that. So hopefully that gives you the answer.
So, sir, since you did talk about this 200 to 300 basis points improvement in the margins over the medium term, even though you had reiterated it today, but even before you had mentioned it about a year back as well. So, medium term would mean what? Because last time you did not mention any kind of whether it would be 2 years or 3 years. And next year, if we are hoping to see same margins at 14.4%, do you think this will get delayed by a few more years? How could you explain that more in greater detail to us?
Sure. So if you look at it, the medium term for us means 2 to 3 years. Now, having said that, look, we live in a dynamic environment. In this dynamic environment, nobody can, forecast with a crystal ball. We can tell you our aspirations to go where we want to go. But if there are conflicts that arise in different parts of the world, if the Fed decides to delay the rate, decrease part of it, the rate cut part of it, and so on, and the market conditions remain tight, then if we are relatively outperforming the market big time by growth, taking market share, all of that is based on investments that we are doing in technology build, which is basically capability build, because of which our customers engage us, and taking market share away from our competition. Now, as the market eases, that gives us a very good leverage on all these investments and gives us the right accounts to scale. And hence, it is very easy for us to optimize for margins at that point in time. If anybody starts optimizing margins at this point in time, you are going to compromise the growth. And we are in a very sweet spot. We have doubled the company in the last 4 years. We have a very good chance where we are getting invited to the bigger bids against the who's who in our competition. So right now, it's a time for us to take market share, optimize margins as we can, whether in this year or going ahead. And we are confident of doing both.
Okay, sir. So, as far as the demand situation is, how would you explain that? Since you were talking about constantly that Fed rate hike is going to be something that you are watching out for. But what is the current demand situation? Till when do you see an improvement really coming about? If the current situation remains same as the last 2 or 3 quarters, by when do we see an improvement?
Yeah, so actually, look, nobody has a crystal ball. All we can see is what is, panning out as we go along. So if the conflict in the Middle East expands, that is a different bearing. That is a different bearing on the entire world. That is a bearing on Fed actions in terms of interest rates. If the inflation in the US does not subside, that is an impact on the Fed rate cuts. So all of this pans out in people like us who are bigger businesses, the customers that we have reacting in a certain way. So all we are saying is the demand environment right now is tight. People had expected it to easen up. These conflicts have not done any justice to that. So we'll let the entire thing pan out. But good macro, bad macro, we will take market share. We are at a very good cusp. We have the best ratings from our capability perspective, and we have a good seat to the table, right to win in our customer base and prospects.
Okay. So as far as the deal win momentum is concerned, that seemed to have slightly moderated in Q4 when we compare it to the previous quarter. It was down 14%, even though it came in at $447.7 million. How do you explain, how do you expect this to pan out going forward from here, sir?
So if you look at it again, the bigger picture. So just looking at the deal wins by themselves is one picture. If you look at the bigger picture of it, two dynamics. One, the last year, as in FY23, the industry grew at 10%. FY24, the industry grew between 2.7 to 3%, depending on whose data point you take. So if the industry overall is growing lesser, it is because the demand environment is tight, because the bigger businesses who are customers and prospects to us have lesser propensity to kind of spend given the tight macroeconomic scenario. Now, as that eases, so will the order book go up because the market will overall expand. So within that, that is one context. Second, Q3 for us is October, November, December quarter. 80% of our revenues come from the US. Hence, a lot of our bookings, which are renewals, etc., also pan in the Q3 side of it. And not just this year. Historically, if you look at several years, you will find that seasonality play out. So that is the context, both the quarter and the overall picture from a demand environment.
Okay, you've actually logged deal wins above $400 million for third quarter in a row, so that is a bit positive. But when do we see $500 million going crossed?
We are at it, and as soon as we can do it, we will.
Okay, so attrition levels also came in, down at this point in time. So that's a bit of a positive again, from 11.9% to 11.5%. Are you comfortable with this? Do you see it going down as well?
So look, attrition has multiple different facets to it. So one is overall the demand environment, because as the demand goes up, there's a demand for talent, and that basically leads to more attrition because the opportunities kind of present themselves to our employees and others. Now, if you look at the demand environment, that being tight, industry not growing well, that has also led to the attrition being in this range. And second is the initiatives that we have as Persistent, the learning and development capabilities that we provide to our employees, the employee value proposition that we have for our employees, the employee engagement that we have. So all of that is a combination of things that we are seeing lowering the attrition rates. We are comfortable where it is. Anywhere between 11 to 15% is a good, comfortable band for companies like us.
Okay. So also on the hiring trends, if you could highlight a little bit more, we've started FY25 now. What is the kind of outlook that we can expect from you, especially on the headcount front as well, since that's been constantly coming down for even your larger peers? I wanted to get a sense from you. What is your own sense as far as the employee count is concerned and the hiring trends?
Right. So look, we will not talk about the forward-looking statements, but let me just give you the context for the last several quarters. If you look at the last two quarters itself, our net headcount addition is more than 500. So that is basically reflecting the growth that we have had over the last several quarters, and also a capability build and a capacity build for the future quarters. So we have had a good growth over the last several years, last several quarters. As we go ahead, it'll be a combination of lateral and fresher hiring, more lateral than fresher hiring.
Okay. So also on Gen AI, you have been constantly focusing on that. How do you see, the growth in this space, particularly driving revenues for you in the medium to long term perspective, as well as if you could highlight for us, would you be hiring afresh for the growth opportunities that you see in Gen AI, or will there be internal skill sets that you will develop for growth in Gen AI?
So look, so I'll start in the reverse order. Gen AI, if you look at 18 months back, not many people were talking about ChatGPT or Gen AI. So it is not this that there is a lot of talent on the street, which is there, which is like qualified on Gen AI and so on and so forth. And so if anyone says that, we can go hire from the street, a lot of engineers on Gen AI, it's going to be a little fallacy. Having said that, Gen AI is a subset of a bigger AI play. Persistent has always been good in AI. So we have a scale in AI. We are training those people to take on the next part of it, which is generative AI. And so it'll be homegrown talent or bringing talent on a certain skill set and then growing them the way we want to deliver on the generative AI components, whether it is on engineering side or enterprise side. So that is the play on that. In terms of the revenue growth, pure Gen AI projects as of this point in time may not be huge, but what they are spawning off is when anybody does proof of concept, wants to take it to production, it is going to spawn off a significant amount of data, cloud related projects. And that's where we are seeing big time growth in our data and cloud businesses. So that's where it is.
Okay, well, many thanks, Sandeep sir, for being with us and sharing all these wonderful insights. All the very best to you for the upcoming quarters. And here's hoping that we can catch up with you very soon to understand more about how the developments are shaping up across the globe and for the industry and the company going forward. Many thanks, sir.
Perfect. Thank you.
Thank you, sir. Thank you, sir.